Hello. Welcome to Capital Street. As we have discussed in the last video, there are three parts that make for an exhaustive market analysis: fundamental analysis, technical analysis, and sentiment analysis. Today, we will dig deeper into one of them: fundamental analysis. Fundamental analysis is a method of evaluating an asset's intrinsic or true value by considering related economic, financial, and other qualitative and quantitative factors. From a hotshot analyst on Wall Street, who is managing billions of dollars, to a regular investor, all must pay really close attention to real data and information, especially which has enormous effects on the intrinsic value of a certain financial asset. Macroeconomic variables, such as interest rates, retail sales, inflation, which can be evaluated via consumer prices or producer prices, unemployment, industrial production, consumer confidence surveys, often create a massive impact on multiple markets and assets at the same time. Meanwhile, company-specific factors including revenue, earnings, future growth prospects, return on equity, profit margins, help investors determine a company's underlying value and potential for future growth. These measures mostly exert impact on the relevant company's shares and bonds only. Out of all of the mentioned factors, interest rate decisions or news related to interest rates normally affect the market the greatest. This is because interest rates are probably the biggest element in determining the perceived value of a currency, the attractiveness of an economy, and the scale of future economic growth. The higher a country's interest rate, the more likely its currency will strengthen. Instances where the interest rates of two countries move in opposite directions often produce some of the market's largest relative swings in their currencies and all related financial markets. Most traders and investors don't spend their time focusing on current interest rates, because the market has already priced them into the currency price. What is more important is where interest rates are expected to go. For example, Euro versus USD. In the period from November 10th to December 3rd, 2015. This pair witnessed the monetary divergence between the US Federal Reserve and the European Central Bank. While the Fed wanted to raise interest rates for the first time in almost 10 years, the ECB was widely expected to introduce additional measures to drive rates in the opposite direction. Consequently, the greenback consistently rose against its European counterpart, pushing the pair down almost 1,000 pips in 1.5 months. Some pressures last long, others only spike the market volatility for a while. In our example of euro to US dollar, after the ECB decided to hold its rate steady, instead of lowering it in December's meeting, the euro immediately shrugged off all its burdens, to fly as high as 400 pips in just a day, pairing most of its losses in the previous month. After that, the market traded sideways for 3 months. On different assets, the degree of the impact from each news or data release is different as well. Therefore, there are 3 things you should watch before each news or a report's released. Is the report significant? The time when the report comes out, and the consensus expectation or forecast in the market. Some traders don't trade the news, but others love jumping onto a moving train. Higher risk comes along with higher returns, right? We will go into details of how to trade the news in the next video. Thank you for watching.